I am pleased to introduce what I'm calling the Ally All-Star panel here. We've got it led by Emily Shalal, and she's going to be joined by some of our Ally Invest colleagues, Nicole Cope and Frank Litke. They're going to be talking about money priorities and a pandemic. And we're going to get their thoughts on how that's shaping the way people view money now. Don't forget, we're going to take your questions at the end of their session. So drop them in the box on the right if you're on YouTube, or put them in the comments section if you're on Facebook, Twitter, or LinkedIn. They will be taking your questions, as many as we can, at the end of the presentation. We like this conference to be very interactive. Keep the energy going. Give me a high five, a big smile, a fire sign if you're excited for this panel, because I am. With that, I'm passing it on to Emily. Take it away.
Hi, guys. Welcome to Money Priorities in a Pandemic. We're super, super excited for this conversation today. And I think to kick things off, we really want to hear from you. So we're going to do a quick poll. So if you guys could go to ally.com/live poll, that's ally.com/live poll, and answer. We want to know about your money habits during the pandemic. Have they improved, worsened, or stayed the same? So while we're letting you guys answer that poll, we're going to get started with Frank. So Frank, I'm really interested in hearing from you and really how your habits have changed over the pandemic. And if there was a lesson that you really learned that you're going to keep with you after the pandemic is just a long memory for you.
Thanks, Emily. And it's great to be here today. And thank you, Lindsay, for the introduction. And, these digital conferences have been something that's been incredible to participate in. So it's great to be here with all of you today. As I think about the biggest lesson I learned, or the takeaway, the lasting impression that some of the pandemic impacts had on finances and my money and thoughts about investing, it was by far to stick to a plan, to stick to an established routine and what you've set up in your long-term strategic goals and priorities. Many times when engaging in your finances, it's really easy to get influenced by the now and what's happening. Absent any catastrophic events such as a job loss or a major life change, in general, I've always read and learned that it's better to stay on track with your plan. The reason I bring it up is probably one of the biggest impacts, or the urge of emotion that I had during the first parts of March, April of 2020 was, wow, the world is melting down. COVID is officially a pandemic now, and we have massive impacts on the S&P 500 and single name securities. The gut reaction many times is to pull out, sell, and or stop contributing to your plan, which might be tax advantaged accounts, brokerage accounts, et cetera. Looking at the data, we know that the largest recovery period is just over 5 years from the time that a market had its trough moment, or all the way down, to full recovery. So I tried to ask myself and reassure in my plan, if I don't need the money that I have invested for my 401k, retirement, and brokerage accounts otherwise, why would I change that strategy and that plan that I've set forth to increase and contribute wealth and advance our financial profile and life over the long term? So the biggest thing, the takeaway, looking back now, right? Hindsight's always 2020, but we see that the S&P 500 and many single name securities recovered. Had I sold out of panic when it was down 20 to 30%, or stopped contributing, I'd generally be in a worse off position than I am today in my portfolio balances and general financial profile. So that's probably the biggest takeaway, was to ensure that I stayed out of my plan and continue to contribute and resist the urge to completely change course based off one event or a series of events that happened in the market.
I think that's great. And I think just looking at the poll results, if you guys can see, most of you said your financial position has actually improved since the start of the pandemic, which I think a lot of people at the start of this had a lot of fear. And what we've seen is a lot of resiliency. So speaking of resiliency, if Nicole, you want to answer the same question, I think it would be really interesting for people to hear from you and what really important lesson, if any, you've learned over the course of the last 18 months.
Yeah, thanks, Emily, for the opportunity. So like Frank, I'm a consummate planner. However, pre-pandemic, if I think about wealth, I always thought about wealth equating financial independence. Simply, the adage of being able to do what I wanted to do when I wanted to do it. So for me, money really provided a peace of mind. I've since shifted that perspective. So money is no longer for me, at least the end all be all, but simply a tool. And so, you may be wondering, like, what caused that shift? And so, like many Americans, we experienced a job loss in our household. So my husband lost his job, and we went from a dual income, no kids, so we were dinks, to a single income. And during that time as well, we also moved my mother in with us for some health and financial reasons. And so, it was a little bit of a moment like, what do we do? Like rest of America, I think we kind of paused, looked around and thought, okay, now what? And luckily, because I've always been such a strong financial saver and planner, we were fortunate enough that we had that emergency fund. So the impact of it wasn't as great as it could have been for many families out there. So, when we kind of came up for air after the news of my husband losing his job, what we decided to do was make sure that we were paying ourselves first. So by that, I mean, we continue to save for retirement. I continue to fund my 401k at the same pre-pandemic levels, prior to my husband losing his job. Both of us continue to make our IRA contributions. And some of that money actually came out of that emergency fund. And then the second thing we did with all of that was we took a serious look at our budget. And so we were able to really cut out a few things. Like I finally cut the cord with cable. And, like most people, maybe have increased my digital appetite with some of the streaming services. And we also gave up, which was difficult for me, we gave up a lot of our charitable contributions. I've always been of the mindset that I've been very fortunate to have the life that I lead. And I always made sure I wanted to care for others in the mindset of through charitable giving. And but what we realized was that there were actually really safe ways. And because my husband now had some time on his hands, for him to be able to commit more time. So while we were not giving our financial support to the charity, to dedicate time. And that was just as valuable for a lot of charities. So, kind of wrapping all of this up, at first it was, we felt like, oh no, what are we going to do? But we had a plan in place. Like Frank, we followed kind of that plan. We had the emergency fund. We continued to save for ourselves, and we looked into our budget. So in all, really money, that shift in that perspective for me, money then just became a tool, one of many tools that can help me have peace of mind. But I realized it's not the only thing that brings peace of mind. Health became just as important, as well as some of the independence that having time back in your day from like not commuting, et cetera, can give to you. So it's kind of where we were through this pandemic and how it really impacted our family in particular.
I think that's great. And again, I respect so much people who face adversity. Oh my God, I can't speak today. Just like Lindsay in the last session, we're on this together. I think if you face a challenge like that and you can come out stronger on the better side, it shows how Americans, we can be as resilient as we want to be when we put our mind to something. And so I think what we have found just in our own research is consumers are finding just generally that they are in a much better financial position and they are feeling a little bit more confident. And so that leads me to my next question, which Nicole, I think I'll start with you, but I think, we've been seeing over the course of the last months that consumer confidence actually has been really resilient and people are staying pretty, confident and hopeful of their financial position going forward. So, are there any insights that you could provide the people listening today on why we think consumers have been so resilient, why their confidence level hasn't been suffering, and what do we think is driving it?
Yeah. So, I think early on at the start of the pandemic, we were all forced to be put on like a discretionary spending fast. You think about it, like a lot of our discretionary spending was cut because the restaurants we go to were closed, the movie theaters, et cetera. So we were put on that fast. I've started to hear this term come up now more and more in financial circles, as well as like my own friends. And I hear some pundits using it as this whole term of YOLO ATP, which is, you only live once after the pandemic. And so that I think has a little part of like this resiliency. So all of that pent up demand and the savings for some, like I fully realize that not everyone was in, the same situation that I was here. So, but for a lot, there's this pent up demand to spend. And we've had these savings because of that forced discretionary spending fast that we were put on. And that's led to, I think, a lot of the optimism we're seeing from consumers. But my caveat for that is like, then what happens when we go out to spend? And I think this is why we see some of these mixed results of some people feel better, some people feel worse, is now when you go out to maybe spend or reemerge from into the economy, we're seeing inflation. We're seeing inflation around us. We're certainly seeing specific sectors and specific items that are inflated much higher than others. You think about cars and housing and some of those consumer durables out there. And that can leave some people feeling worse off because it's eating into their already stretched budgets. So I think that's why you see this kind of mixed results on consumer attitudes when it depends on who you ask, I guess.
That's right. So Frank, anything you would want to add on, just consumer confidence or resiliency and why?
Yeah, it's interesting, Emily. So unemployment rates right around 4.8% most recently, which is not as great as it was pre-pandemic in the sub fours. However, we're starting to see some of the trends that Nicole had mentioned with inflation's super low rate environment, right, compared to historical norms, and consumer price index continue to increase, not necessarily an improvement, but increase month over month, about 0.4% or so the last month. And we continue to see it creep up. So the demand is there. The supply still remains disrupted. So I could see where the 36% feeling the same or 23% feel worse, not having access to some of the goods that we might want or consumers might need, might be weighing in on that 36% of feeling the same, or some people actually feeling worse. But if you look at the numbers compared to, even the beginning of the pandemic, unemployment has improved, and you can start seeing some of those more macroeconomic indicators play into how people actually feel and where we're at in terms of the market. You look at aggregate asset prices, we've had a decent year in 2021, and certainly higher in terms of, or better, lower VIX compared to where we saw in 2020, particularly in the middle part of the year. So all those macroeconomic factors are kind of playing into the consumer sentiment field.
I think that's spot on. And so I think, when we've been doing our research with consumers and our customers in general since the pandemic started, I think what we have found in our research is that, nearly half of us really tried to decrease our spending when the pandemic started. And I think we have a slide that showcases some of this research, but, there's been a lot of talk in the last year about, the change in people's behavior. And some of it was forced, some of it was intentional. But, what have you guys been seeing in terms of how people have changed their changed their behavior since the pandemic started? And Frank, maybe I'll start with you on that one.
Well, we certainly see people more engaged in their financial life as it's measured by activity or engagement and trade volume across the broker-dealer landscape. You've seen many different broker-dealers and investment shops talk about increased engagement via trade levels. We've seen similar trends at Invest where people are more involved. They're changing the way in which they become engaged as well. Digital, social-driven engagement has been part of how consumers are digesting news now. And that seems to have naturally increased engagement in terms of trading levels, how many times consumers are signing on a monthly basis, so on and so forth. So, the changing dynamics, certainly of being in a digital world and not being face-to-face, could be part of the reason why we're seeing increased engagement in the investing and wealth management landscape.
So, Nicole, I'm going to ask you the same question. And I think, even focusing on long-term habits that you think are here to stay, any insight or any kind of tidbits, even from a wealth standpoint that you've seen?
I don't know if Nicole's.
I think we must have
Yeah, we're
lost.
a bit of an internet problem. So I'll talk a little bit about, people's, behavior. Certainly, every discretionary good people seem to want or need right now is out of stock, and part of that is supply chain issues. But just qualitatively listening to the news about vehicles and luxury items, recreational items, the RV market, the marine and boat market, the discretionary market, very small inventories. Part of that's the supply disruption. But in listening to some of the surveys and talking to either dealers or people that are salespeople in these spaces, the demand is super strong. So discretionary spending for things that are outside of the basic necessity and needs, like marine and otherwise I mentioned, remains extremely high. I think that's a big part of, and it speaks to people's increased, not necessarily engagement, more along the lines of security or feeling of return to normal a bit, as at least as it pertains to finances. But I know we have Nicole back with us now, and I'll turn it over to her to continue to talk a little bit more about that.
Yeah. So Emily, I'm sorry, we're having some Wi-Fi issues here. So what was the question? And I'd be happy to address.
It was a question just about how consumer behavior has changed since the start of the pandemic. And my specific question to you is if you had any tidbits on the wealth side of things, if you've been seeing anything on that front.
Oh, yeah, that's a great question. So thank you so much for that. So from the wealth perspective, like consumer behaviors have changing. Certainly we're saving more. So we're seeing that then in increases, as Frank might have alluded to, in self-directed accounts. We've seen investors almost use or turn to the markets for entertainment purposes. We saw that run up with some of the meme stocks. And then otherwise, like from the other, if you think about the other side of wealth, if you think about the planning side of wealth, what this pandemic has taught us is that if we did not have a plan, we were kind of caught with our hands in the air. But those who have had a plan and had the intestinal fortitude or the advisor's support to help them navigate through this time actually came out better on the other side. And I think the second part of that with wealth especially is you're seeing a lot of adoption too of technology in that space. So in the past, most individuals, when they were meeting with advisors or dealing with their banks, they thought they had to do that in a brick and mortar setting. And what the pandemic has taught us is that you can do those things virtually. You can do them through Zoom meetings, over phones, et cetera. So from a wealth space, I really see how advisors engage with their clients changing. I don't see as many advisors anymore having or relying upon those face-to-face meetings as a way to engage with their clients, but certainly using technology as a way to change their engagement with their clients.
Yeah, I think it's great. So we did a pulse check with consumers asking what habits will stick as well. And we have a slide that showcases some of the results that we learned, but we haven't even touched on the topic of working remotely, but, a lot of people think that the notion of being in an office and being physically located has changed forever and we may never go back. I think people have realized that there's also a quantifiable impact to spending more time at home. I think, there was a person we talked to a couple of weeks ago and he said, I was always on the road. I'm a consultant. I lived in airplanes and hotels and I spent 6 months with my family. And that's time that, has a huge incremental value to him. And he didn't see a world in which he could ever go back to the way that things were. And I also think the earlier, topic that we talked about, which is just, controlled spending. I think we as Americans are bombarded with, the notion to spend. You're going to see sale signs, you see commercials encouraging us to spend, and the temptation is everywhere. And I think, Americans since the start of the pandemic have done a wonderful job really trying to prioritize where they put their dollars. And, I am so hopeful for the health of the consumer going forward that habit sticks. So with that being said, we're going to continue to plow along. So Frank, what do you think, or what are some good tips for people on just how to approach financial planning in general, especially when they're facing uncertainty and things that are well out of their control?
Yeah, so That's a great question. It's something that many people face, particularly as it relates to the time period we're in right now. The key theme, if you take one thing away from my answer, is personalization. There are tons of different resources out in the market that talk about do this and do that and 10 top things you can do right now if you want to be a millionaire. Personalization reduces a lot of that noise. Get with a certified financial planner or a registered investment advisor that's going to sit down and listen to what you need, what you want out of your financial priorities and goals. Not all investment options are suitable for different sorts of people. Not all funds, portfolios, strategies are one size fits all. Certainly, there are generic financial advice, like you should save part of your income and things like that are applicable for everyone. But when it comes time to really set up a plan, get personal. Explain your situation to your advisor, or even if you're doing it yourself in a self-directed fashion, consider your risk tolerance. How am I going to feel if the market drops 30%? What actions am I going to want to do? If I feel like I need that money right away, then a certain portfolio, a certain strategy might be right for you. Others might not be as suitable. Risk tolerance is part of it. Time horizon, the time in which you're going to need your funds before, pulling them out and needing them for retirement or that big purchase. A lot of it could be around if you plan on moving, or if you have a child going to college or want to plan for a big life event, such as having a child or planning a wedding. Time horizon's a big part of it. So personalization, generic financial advice works at a very high level, but you have to get personal and work with your certified financial planner or your RIA. Or, like I said, if you're doing it yourself, consider those factors, because generic advice can be helpful at a very high level, but it's not the best route when it comes to the specific events that people need in their life.
I think that's great advice, Frank. So, Nicole, I'm going to ask you the same question, especially since you did just, experience your husband's job loss. And I know you touched on this slightly, but, what were some of the things that worked really well, or that you think people should be mindful of when experiencing uncertainty to make sure that they can protect their financial self?
Yeah. So, I alluded to it earlier. I've always been a proponent of financial planning for all the reasons that Frank mentioned prior. But if I think about kind of what helped us in the immediate time, and something that's really going to stick with us as we move forward, was really budget. And so we turned to technology to help us do that. There's a ton of wonderful budgeting apps that you can use that will help you create, stick, and understand your budget. So again, I'm in the industry. I've worked with financial planners. I've done the job. However, sometimes just the basics, you have to go back to the basics. And so for us, it was budget. The second thing the second piece of advice I would give is reverse any COVID related changes. And so by that, I mean, if like I think Frank mentioned earlier on, like he thought about like, well, do I need to reduce my retirement savings? Do I need to do this? If you pulled the trigger and you reduced some of your retirement savings or your 401k contributions, revert back to that pre-pandemic rate that you might have been saving at. And if you've been in a great position that you were able to save some money during this pandemic, don't let that flitter away. I save it, put it toward a 401, or put it towards your IRA, put it toward a self-directed investment account. Think about how you're going to save that, make that work for you. The same would go for any debt decisions you made before COVID. So if you were trying to snowball your way through paying off debt and you stopped because of COVID, go back to it. If you were paying off, think through your debt. The third thing that we did and that was really important to me is I really now spend with intention. And by that, I mean, I reflect on anything before I buy it. So how do I do this, right? We're all a little bit impulsive. We like to shop. We've all certainly have maybe adopted more online shopping than we have ever had done before. And so what I do is I online shop, I build my cart, and I walk away. I leave it there for a day or two. So it gives me time to reflect on, like, is this stuff I really need? Or is this just kind of fulfilling a quick want of mine? And so two things came out of that. I found out that I buy a lot of stuff I don't need. And so we really reduced what we were buying. But secondarily, companies or those companies that I was shopping through would send you coupons when they realized things were sitting in your cart for a few days. So it was like a win-win. And then the other thing I would say is, so if you're not shopping online and you're in person and you want to spend with intention, walk the store before making the purchase. Like just having that moment to kind of pause, reflect, and let that impulsive need pass. And then the last thing that we did a lot of, and we will continue to do, is shop around. And so I now price comparison everything. And I turned to technology for that. There's some great price comparison apps that you can just go into, the App Store and find, as well as like coupon browsing extensions that you can add to any of your online carts that will help you find secret coupon codes, et cetera. And then lastly, we realized that if it's not a need, hold off on some of those big ticket items until prices normalize. So before I got cut off, I'd heard Frank talking a little bit about, a friend of his who was in the market to buy a boat, and like that they were booked out right for a year. So that's going to come at a premium because the demand is higher than the supply. So it's going to come at a premium. So if it's not a necessity and a need, hold off on those big ticket items.
I think that's great. Go ahead, Frank.
I can certainly relate to the deal shopping, Nicole. So that's something that my wife likes to give me a hard time about. She's like, you always have to, not pay full price for something, or make sure you're looking at 3 or 4, options. And I'm like, yeah, I mean, that's part of my DNA, but that's great advice in terms of like trying to make sure that the fit and what you're spending actually aligns up with what you actually need, and to make sure you're getting the most value, not just the cheapest product, but the most value you can. Certainly something I try to utilize.
That's right. I think that's great. And I think too, one of the things to just keep reminding yourself is, I think as humans, we're pretty hard on ourselves. And I think the reality is, when you hear Nicole talk about budgets, if you're early on in your savings and investing progression, just remember that it doesn't have to be some really complicated thing that puts you on what some people would call a financial diet. Just take it one day at a time and rationalize those decisions. And for every day that you make really good, healthy financial decisions, you're one step closer to your goals and dreams, and it'll help you feel really connected to your money. So, okay, we are coming into the home stretch. I want to be mindful of time so that we have plenty of time for everybody's questions. But Nicole, what do you think are some money and financial trends that are going to carry us into 2022 as we think about the next 12 months?
Yeah, so certainly, consumer spending will continue. Like I said, that kind of forced budget we were put on, or that forced restriction of some of that consumer spending, I think will uptick. Inflation is something we'll have to kind of watch as we go through. But if I think about areas of where we're seeing consumers as well as investors have more and more interest in, I not that I have a crystal ball or anything, but I would see that I think that crypto will likely become more mainstream. And by that, I mean, you're starting to see it normalized as not necessarily so much of as a ancillary asset class, but more of something that, everyday Americans are interested in. And the second part of that is like the blockchain technologies that support crypto. It'll be interesting to watch how those two areas over the next 12 to 24 months play out as it becomes normalized within Main Street investing.
All right, Frank, this is an important question, so I'm going to ask you too. What are you seeing kind of on the edge of becoming a trend that most consumers are talking about next year?
Yeah, so what seems to be sticking around is the way people ingest their news and makes financial decisions is becoming more and more technology driven, socially driven, online. What's in the news? I think that we'll continue to see trends that are driven by what's popular. what is, so to speak, viral, and you will have engagement in finances around key themes, and single name securities will be, impacted by viral means, social means going forward. The fundamentals are currently there. I think that, again, not trying to make a prediction on the market overall, but in the crystal ball fashion that Nicole had just mentioned. However, I do think the fundamentals continue to be there. Supply chain is something that needs to be figured out. There are certain analysts that predict that we'll still be in a situation in 6 to 12 months from now where chip shortage and other supply chain woes are still being figured out that could have an inflationary impact in consumer price goods going into next year. So I think that'll continue to push inflation up. It's all going to depend upon what happens with the rate environment. One could speculate that rates will continue to rise to combat any inflationary concerns, particularly as equity prices move. So we could see some fluctuation going into next year on all three of those aspects. But as long as unemployment remains low and consumer confidence remains high, I think that generally speaking, we'll see a decent continued climb in terms of sentiment and everything else in the market.
So I think we may have time for one last question. So, as we've touched upon as part of this conversation, Americans in the last, since the beginning of the pandemic have really done a really good job saving money. So for people who, have saved and now have an emergency fund and maybe sitting on some cash, but have never really gotten into investing, Frank, what's some advice on how they should think about things? I mean, we saw the rise of GameStop and the self-directed investor craze that happened earlier this year. So just any advice for somebody who's just kind of starting this journey on the investing side?
It goes back to that's another great question. It goes back to my point earlier. Figure out personalization that works for you. What works for your friend investing in GameStop and AMC might not be the best option for you if you're don't have the same risk tolerance, or you're not as diversified, or have portfolios in which you feel confident about your long-term goals, and then you have other buckets of funds or investing money to be able to take speculative risks on. So making sure you sit down and realize, okay, doing a simple budget is a good place to start. I'm a big fan, as Nicole mentioned earlier, of paying yourself first. So sit down and do a simple budget. Understand what your monthly needs are versus your income. Try to set up a savings goal every month, even if it's starting small at 1%. And climbing up to 10%, making sure that you have the means to pay yourself first and get into a good broker dealer or RIA that can help you meet your goals. The folks, some of the mistakes sometimes are made when people think that you need $1 bazillion to start investing. The great thing about where we're at in digital wealth management is it has been democratized for all over the last several years, specifically in the last 10. Transaction prices have come down. Minimum balances are very low to be able to open an account. So just get started. The threshold of beginning is oftentimes the hardest part of actually getting engaged. Open the account. You can do your budget. You can figure out what you need to contribute on a monthly basis, but you can start small. There are certain RIAs out there that have $100 minimums. You can open up most broker-dealer self-directed accounts with a very low minimum. And getting that account open and setting up some type of contribution is the major hurdle, mentally and otherwise, that people often face. So get started, figure out what works for you. If you're someone that's, I don't want to mess with this, I'm not into reading about the markets and everything else, check out a robo, check out an RIA that might have a very simple, low means of entry, like a low balance. They'll ask you a few questions about you. It goes into that personalization aspect I talked about a little bit earlier, figuring out what's right for you, your risk tolerance, your timelines, and your goals. Those questions will be asked, and you'll be able to set up a portfolio commensurate with those goals. Just get started. If you take anything else away from it, open the account and get figure out what's good for you, personalization, and then set on that plan. That third piece is set into that plan I talked about earlier. Stay on that plan. When you meet with an RIA or other certified investment professionals, you will get a plan set up, right? So stick on that plan and try not to let small market events or even large ones materially distract you from what your long-term goals are. So get started, number one. Number two, personalize. And number three, stick to that plan.
I love it. I love the whole aspect of just get started. I think, one of the things that we found in our research has been people's future self is their best self, right? And tomorrow may never come for the person. So it's always better to just take small action today versus waiting for everything to work out and for you to start tomorrow. Start today. I love that. Probably the best advice that we could give you during this session today. So I think that, let me see, I think for timing, Nicole, maybe just a quick answer to the same question for you, which is if somebody has been dabbling in investing and maybe they've been thinking about a financial advisor, how do they know when the tipping point occurs from when they should probably seek some professional advice?
Yeah, that's a great question. And if you stay tuned, we'll go into that in greater detail in my session. However, I think a broad answer to that would be when they need that customized, personalized advice, right? So if you are starting out and you're just learning about investing, you're educating yourself, I would always say that, when you look around, I always hear my mom in my head, like when I think about investing, is that like, would you jump off the bridge if everyone else jumped? Right. And sometimes I think that a lot, like the meme stock craze and whatnot is just that. So I would say educate yourself. Make sure you have a plan in place, whether you're doing it yourself or you're going to an advisor. There's a saying I used to tell my clients all the time was a goal without a plan is just a wish. So when that money becomes a tipping point for you where now you really want to put it to work for you and you want it to fund those goals and wish bigger, that's the time to seek advice. When you have reached the limits of either will, skill, or time, and by that I mean you no longer have the ability to sit and watch the markets day in and day out, because to be a true professional at do-it-yourself investing, it takes time. And so if you don't have that time or that will to do that day in and day out, you may want to seek advice from a financial advisor to help you do that. Or if now you're in over your head. So there's that skill part. Like if you've reached where you want to go with education and you realize that there's probably more to learn, you don't have the appetite for it or the time to do it, great time to seek professional advice.
I think that's great. And so just another plug for Nicole's session. If you are interested in that topic, tune in later today to find out more about, professional financial advice. So maybe in 60 seconds or less, Frank, anything top of mind or any other parting information that you would want people to know about when they think about investing or the pandemic in general?
Tomorrow's never known. It really isn't. And it always, the pain of going through it today, of setting up a plan, and when I say pain, it's relative, right? Rather than looking at Instagram or Facebook on your phone, which is easier than talking and going through an account set up for a broker dealer or a questionnaire for an IRA. Spend the few minutes, get started. It's the biggest hurdle. It'll be the biggest aspect that could help you build a better financial life for yourself and your family. So get started, get personal, and stick to that plan. I can promise you that nothing's ever known, but the future can generally be better off if we take the steps to plan today.
Amazing. So I want to just say thanks, Nicole and Frank, for your honest and very insightful answers to the questions. Appreciate your time through this. And I think we have Lindsay again.
Yeah. Hi, everyone. I'm back. I mean, what types of nuggets do we get from that conversation? We got some important nuggets of information. Just get started. Tomorrow's not promised. always listen to your mother. I mean, that was a good conversation, guys. We do have a lot of we have a lot of questions from the audience too, so I want to get to those. You really sparked their interest, so let's get started with at Kenny Rich. What's the best way to track your wallet across different parts of your wallet? So that means savings, debt, real estate, etc. Nicole, why don't I throw that one to you?
Yeah, so there's a lot of organizational tools, online tools, like aggregation tools that you can look at that will allow you to put in all of your investments, link your investment accounts, link any kind of equity you have, like your real estate, et cetera. And it also will allow you then to link your bank accounts. So it will personalize and customize, and you'll get a better snapshot of where you're spending, maybe where you could save a little bit more. So I'm leaning on technology, but I'm assuming since all of you are on one of our technology streams watching this, you too are somewhat digital natives. So a lot of great aggregation tools out there that you can utilize for that. If you feel that that is bigger than what an aggregation tool can offer, always seek advice. There, as Frank said, there are RIAs, there are financial consultants that can help you understand and get a holistic picture of all of your assets. And so, again, if it's bigger than a tool could support, please go seek advice. It's the best place for you to be.
Yeah, I mean, I think you're spot on. And I love that this group is thinking about their finances, their wallet in that holistic view, because, in the past, it didn't always used to be that way. And technology, like you said, makes it so much easier now. All right, we've got a bunch of questions. So I'm going to keep going and keep submitting your questions too. If anything's top of mind, we're going to get to as many as we can here. So we got at Flower Squad. Love that name. What should I look for when choosing a book or podcast about money? We talked about some books and podcasts and blogs too. Frank, I don't know. Do you have a favorite book or podcast?
There are a lot of good ones out there. I'm not much of a podcast person. I know there's a lot of good ones out there. I usually go out to the Amazon bestseller list for different recommendations, but there's a few good ones. Rich, if you're looking at personal finance and just habits and behaviors, Rich Dad Poor Dad's a pretty good one that I've always recommended to people to just check out in terms of changing the way you think about assets and liabilities. The most striking thing is a lot of people think about their primary home as an asset, when in reality, it costs a lot of money and it requires continual maintenance. So from personal finance aspect, that's a good one, Rich Dad Poor Dad. Or, if you're more interested in the markets, The Intelligent Investor is a core that, I read many, many years ago, and much of that fundamental analysis thought process still sticks with me today. So if you're interested in that, check out, The Intelligent Investor. And I think that's a good one there. And the other one, as you talk about and think about different subtopics, if you wanted to get out of debt, if that's a goal of yours, or you want to grow wealth, just searching for that on Amazon and Google, might help you get more personalized. Going back to what I talked about earlier, figure out what subtopic you want to get into and read a book there rather than just general financial advice if that's not what you're looking for.
Yeah, those are really great books that you mentioned, Frank. I know I've taken a look at both of those. Emily and Nicole, quickly, is there anything that jumps out at you as a must read for our viewers?
Yeah, so I think our last panel, was it Joy? She was speaking like my love language when she was talking about your cognitive biases and behavioral finance, how that applies, because I think a lot of times people don't give credit to how much their emotions impact their decision making, especially when it comes to finance. So she listed some great books. I'm going to add on a podcast to that list that takes both of those to account. It's also by Daniel Crosby, and it's called Standard Deviations. I listen to it. I learn something new every week when I listen, and it's one of those that I enjoy walking the dogs to.
That is a good one. I actually got to be a guest on that one once. How about that? He's great. He's a great, and he's so great. And that podcast is so great. Emily, do you have a book or podcast or blog that you love?
I was going to say, I think in general, because so many consumers just hit Google, right? And we try to self-serve data wherever we can get it. And I would just say, just read the biographies of the people who are writing the articles, producing the podcast, writing the book, and just understand if they're qualified for what you need. I think sometimes just basic general information is easy to find, but just make sure it's coming from a credible source that you can relate to so that you know that you're on a good path forward.
All right, Frank, I think we got a question from Amit for you. What kind of trends are you seeing for freelancers, entrepreneurs, non-corporate folks, I guess, and their investing strategies? So, those not in the corporate world, not in 401ks necessarily. What are you seeing? Anything notable?
They need more flexibility. So all those freelancers and entrepreneurs, gig workers are becoming more and more popular. The advent kicking it off with Uber and Lyft drivers. Now it's everywhere. Just about every service that one might typically engage a large corporation or a company for can be done by the gig economy. Definitely increased population or really a penetration of folks that are in that sort of work. Some of the things we know about that, your income can be wavy, we'll call it. So you have quite a bit one month and quite a bit less the next month. I would say, as it pertains to the revenue sides of things, $1 coming in, there might be months where you need to meet your financial obligations, debt and otherwise, that are greater than this month's income. The great thing about digital tools and digital wealth management, you're able to change your contributions on a very fast and efficient basis. Most of the time, your mobile phone, you can cancel a contribution, increase it or decrease it to your wealth management account or to your investing broker dealer account. That is a great tool for people's, who have income that are wavy, so to speak, or more one month, less than the other. So utilize that, rather than using an automatic contribution. It might be best to set a timer on your iPhone or a reminder on whatever phone you use, your digital device, to say, hey, it's time, figure out what I can contribute this month, And I think that's one of the things that digital wealth management affords us. And so it really works well for the gig economy workers. The one thing I'd say, though, is going back to the, point I made earlier about sticking to a plan and that third lane, go back to your plan and be true to yourself. Am I following my plan, or am I contributing less this month just because I don't feel like it? Right. So if you have that wavy scenario, it might be an easy excuse to wiggle out of your contribution, so to speak. But if you're wavy in that, you can look at digital tools for contributions that'll definitely make it more flexible.
Yeah, don't deviate from the plan just because you want to get a little lazy, right? Okay. Another question from Sabrina Hines. She says, how can viewers think about their health expenses in the grand scheme of their wallets? Nicole, I feel like that's a good one for you.
Yeah, thanks, Lindsay. So healthcare, it's like the great unknown. It's the unpredictable in a lot of our budgets. So if you think about it in terms of your wallet, both short-term and long-term, I think there's two bits of advice for that. For the short term, always set aside extra money. Like if you're fortunate enough to have healthcare insurance at your employer, look at what your deductibles are for you and your family and find a way to start saving that. So if something were to happen, you have to spend out before insurance starts kicking in, have that money set aside, at least have a portion of it. That's where I would start saving some for the short term. Long-term HSAs are a great way to start socking away some money for long-term healthcare expenses. And then the other thing that I would say, and I may begin to sound like a broken record here, Lindsay, so I apologize, but many planners, if you sit down with a financial planner and they are using software to help create a plan for you, they can actually take into account the expense of healthcare. And so what they can do a lot of times with these tools is extrapolate out how much healthcare is going to cost in the long-term future based upon historical inflation amounts for healthcare. And so, they can actually build that into your plan so you have a little bit of peace of mind that should some of these unexpected expenses of healthcare above and beyond what you normally save for are covered in your plan.
That's awesome. I mean, you gotta beat it into people, Nicole. It's totally okay. Because healthcare expenses really are one of the things that a lot of people don't think about, and the cost is increasing very, very quickly. Well, that, guys, is all we have time for.